High-yield savings accounts. At the absolute safest rung of the ladder, we have high-yield savings accounts. With zero barriers to entry and no lock-up periods, this offers complete liquidity. You can deposit and withdraw your money at any time. These accounts are typically offered by online banks, which pass their operational savings onto you in the form of significantly higher interest rates than traditional brick-and-mortar banks. In the US, your money is FDIC insured up to $250,000, meaning the risk of losing your principal is virtually zero. While incredibly safe, the downside is that their rates are variable. When the Federal Reserve cuts interest rates, your yield will drop right along with them. Certificates of deposit. Moving a tiny step up in liquidity risk, we find certificates of deposit, or CDs. They operate similarly to savings accounts and carry the exact same FDIC insurance, but with one major catch. You must lock your money away for a fixed term, usually anywhere from 6 months to 5 years, in exchange for a guaranteed, fixed interest rate. The trade-off for this absolute safety is relatively low returns, which often struggle to outpace long-term inflation. More importantly, if you need emergency access to your cash before the CD matures, you will face early withdrawal penalties that can wipe out all of your earned interest. Treasury bills. Coming in at number 3 are Treasury bills. When you buy a T-bill, you are lending money to the US government for a short period of time, typically less than a year. You buy them at a discount, and when they mature, the government pays you the full face value. The difference is your profit. Because they are backed by the full faith and credit of the most powerful money printing entity on earth, T-bills are considered a risk-free asset in the financial world. Plus, the interest earned is exempt from state and local taxes. However, their returns are strictly defensive, designed to protect your purchasing power rather than multiply your wealth. Long-term government bonds. Similar to T-bills but with a much longer time horizon, often 10, 20, or 30 years, are government bonds. You lend money to fund national projects, and in return, the government pays you regular interest, known as a coupon. The shift in risk here introduces what's known as duration risk. Because your money is tied up for decades, the value of the bond itself becomes highly sensitive to macroeconomic interest rate changes. If new market interest rates rise, the resale value of the older, lower-yielding bonds you currently hold will drop. Municipal bonds. Stepping up to the next rung, we have municipal bonds, or munis. This time, you aren't lending to the federal government, but rather to states, cities, or counties to build schools, highways, or hospitals. The risk level is slightly higher because a municipality can, although rarely, declare bankruptcy. The biggest draw of munis is their tax advantage. In most cases, the interest you earn is exempt from federal income taxes. This makes them an incredibly powerful tool for high-net-worth individuals looking to shield their capital from heavy tax burdens. Investment-grade corporate bonds. It's not just governments that need to borrow money, massive corporations like Apple or Microsoft do too. The default risk is naturally higher than sovereign debt, and to compensate you for taking on that extra risk, corporate bonds pay a higher yield. The term, investment grade, guarantees that these companies have rock-solid balance sheets. However, during a severe economic recession, even corporate giants can face liquidity crunches, posing a direct threat to your cash flow. Index funds. Crossing over into the stock market, the safest entry point is the index fund. Index funds operate on a passive philosophy. Instead of trying to pick the winners, you simply buy a basket that mirrors an entire market index, like the S&P 500. You are essentially buying the broader US economy. This provides instant diversification, incredibly low expense ratios, and historically consistent returns. This simplicity is exactly why Warren Buffett recommends them for the average investor. However, because it mirrors the market perfectly, if the economy enters a bear market and drops 20%, your portfolio will drop exactly 20%, with no active defensive measures in place. Exchange-traded funds. ETFs are structurally almost identical to index funds, but they introduce a behavioral risk. An ETF trades on a stock exchange exactly like an individual stock, allowing you to buy and sell it minute by minute throughout the trading day. While this liquidity is a technical advantage, it often tempts amateur investors into overtrading during market volatility, leading to emotional decisions that destroy the compounding power of their long-term returns. Mutual funds. Why are mutual funds riskier than passive index funds? Think of a mutual fund as a financial smoothie, where you pay a relatively steep management fee to a professional fund manager who actively picks and chooses which stocks to buy and sell on your behalf. The danger here is manager risk. Wall Street's brutal statistics prove that, after factoring in those expensive fees, over 80% of actively managed funds fail to beat the broader market's average return over the long haul. Dividend aristocrats. Leaving diversified funds behind, we begin buying individual stocks, and the risk immediately jumps. The best defensive play in this arena is the dividend aristocrats. These are mature, cash cow businesses like Coca-Cola or Johnson & Johnson that have a proven track record of increasing their dividend payouts every single year for over 25 consecutive years. You receive steady cash regardless of market fluctuations. Still, you face company-specific business risk. If the company loses market share, the stock price will fall, and management reserves the right to slash the dividend at any time during a crisis. Large cap, blue chip stocks. Blue chip stocks represent ownership in industry-leading companies with market capitalizations in the tens or hundreds of billions of dollars. They are the main engines of stock market growth. While they offer the potential for high long-term returns, they come with intense volatility. A disappointing earnings report or a CEO scandal can cause your equity to evaporate quickly. In this space, the psychological forces of fear and greed frequently drive retail investors to buy at the absolute top and panic sell at the bottom. Real estate investment trusts. If you want exposure to real estate returns but demand the liquidity of a stock, REITs are the answer. REITs own and operate apartment buildings, shopping malls, or cell towers. The risk profile of a REIT is higher than a standard blue-chip stock because they are entirely concentrated in a single sector, real estate, and they are highly sensitive to interest rates. When borrowing costs rise, the cost of operating real estate skyrockets, and REIT shares often face aggressive sell-offs.